My name is Gershon Margolis. I'm the founder of Imperial Advisory. Not outsourced, fractional CFOs. We stopped using the word outsourced. Anyway, so we provide fractional CFO services to growing businesses. So those are businesses that need CFOs but don't need them full time. We also do consulting with smaller businesses that don't need a CFO but need help, and larger businesses that have a CFO but still need help. I'm going to start by thanking Rebecca for helping to put this all together, and by acknowledging the presence of everybody here, but one person gets called out by name, and that's Bob, who's my partner here on Imperial Advisory. So thank you for joining us today. We're working on setting this up. Rebecca sent me something today about that we almost have this up as a podcast. So, ask questions and you'll get famous. Get ready, Jerry. All right. So today we're hosting someone who I met 3 or 4 years ago and who's become a friend over that time. Jerry Freedman has an interesting background for how he ended up doing what he did. That's going to be my first question for him, actually, how he ended up here. But Jerry's been working with businesses in our space, growing businesses and all sorts of businesses, and helping them with getting bank loans. And with, we're not going to focus on it today, but maybe he'll drop in some tidbits about SBA, where he has, I guess, a subspecialty, but he does really bank loans more broadly. And anyway, we're very pleased to have Jerry here to share insight with us on how to get a bank loan, how to get a bank loan in a smart way, and how to use it to help grow your business.
Thank you for having me.
Absolutely. So the format today is a little different than what we, and something else I was going to mention is that Rebecca reminded me of this earlier. We are going on hiatus after this. This is the last one for the season, if you will, and we anticipate picking up our webinar series again after the summer. But thank you all for joining us today. I would say I know most of the people here, a couple who I don't know yet, but hopefully we'll get to meet each other today or sometime soon. All right, so without further ado, Jerry, thank you for joining us.
I'm feeling under the gun here, the last one. I feel like it's got to be super entertaining or something.
It is. It's going to be great. All right. So you have a bachelor's degree, if I recall correctly, in accounting. You spent time as an auditor. Then you went private and did outsourced controller and outsourced CFO work. How did you end up becoming a loan broker?
Yeah, so great question. So just to give you a little brief background. So I graduated in 2012 from Touro College with a BA in accounting. It's actually quite funny because historically the Freedmans have all been horrible at math. So when I told my family I'm going for an accounting degree, I think a couple of heart attacks ensued. But anyways, we got through it. Thank you, Microsoft Excel. Excel definitely saved the day. So I really went for an accounting degree because it was really just a solid business degree. It was sort of all encompassing. It gives you the accounting, marketing, finance, economics. I just thought it would be something solid, before I head out into the workforce. And it happens to be the first job I landed was at a public accounting firm in New Jersey. I started doing tax, a little bit of taxes, a little bit of audits. I ended up staying in the industry for about 5 years. With a focus in the audit space. I audited private companies primarily. After about 5 years, I felt like I sort of maxed out on my experience, what I was looking to get out of the industry. I went and became the CFO of a distribution company down in New Jersey here. After about 11, 12 months, I finally realized, hey, it's time to go. I want to be my own boss. I've done reporting to people. I wanted to be reported to. So I sort of jumped ship, and really my goal was to be more of a freelance, fractional, outsourced CFO, come into businesses on a monthly basis or on a project-specific basis, help with financial reporting. What I started realizing was that everyone had a demand for some sort of bank loan or another, whether it was a line of credit, whether it was a loan to buy equipment or whether it was a loan to buy another business or owner-occupied real estate. And I sort of figured, hey, so why did I audit companies back in my auditing days? Really, the main reason why, and it could be I'm preaching to the choir here, most private companies have audits because they have some sort of bank financing or another, right? No one's just cutting a business a blank check and then saying, okay, great, pay us out over X period of time, or do as you please with the funds we're giving you access to. So we audited them for the bank essentially. I mean, our clients were these private companies, but the ultimate purpose was so that the bank can get satisfaction. Just knowing that their customers' books are in order. Then once I left the auditing industry, I became CFO. It was sort of, I was managing the banking relationship. It was one of my key roles as CFO, reporting to our lender, applying for increases and that kind of a thing. So when I started seeing the demand in the space, some of my clients were needing assistance in helping loans get approved. I sort of just dove right into it. Probably 5-6 months later, I sort of just started shedding all my CFO clients and started focusing on helping companies get approved for business loans through conventional lenders. And that's what brings me here today.
All right. So interesting story. So can you help anyone who's interested? How does a business know when they're ready for you?
Yeah. So help anyone. I definitely can't help anyone. It's very tough to help early stage startups, pre-revenue startups. I don't want to say that it's not possible. I think we have a mutual client or two where I've helped startups get funding. But generally the clients that I seek to work with are more established companies. When I say established, we're talking about at least having 2 years of tax returns under their belts. Generally just have their business model in play, active. They have a substantial amount of revenue. Their bottom line is somewhat strong and healthy. So to answer your question, it's not really anyone. But I definitely do seek to work with more established companies that have a couple of years under their belt.
Got it. Now, if someone comes to you because, let me preface, I used to be in investment banking. So we had different types of situations where people would be getting money. We worked with bonds, and I had this conversation with another loan broker who deals specifically with real estate, and I don't think they do bank loans, but had this conversation with someone a few days ago. And I guess my question is, normally the way I think of it is when you're in distress, that's when you need to go to a broker, because the broker can help you with, again, from the bond perspective, if you were in trouble and there was a story to tell, that's when you went to a broker. But if you had a solid bottom line, then you could essentially cut the broker out and someone was saving money somewhere, and that trickled down.
Right. So look, with conventional lenders, they're not looking to work with companies that are in distress. To the contrary, banks are generally super conservative. Right. If a company's in distress, chances are they're not going to get approved. If they have an existing loan, it's very likely that their loan may get called by the bank. Interestingly, I guess now is a good time to bring up the pandemic. So I think a good question would be well, how are banks viewing the impact from the pandemic? And initially, right, every company had some sort of impact one way or another. Many positive, but most people had some sort of negative impact. So talking about companies in distress, so one way that banks are sort of mitigating COVID is basically saying, hey, well, give us a monthly P&L and let's see like the upward trajectory. Let's see that you're getting back to normal. Let's look at the same thing for 2021. So generally, when companies are in distress, it's definitely a much tougher time to get approved for a loan or a line of credit. COVID obviously is slightly different. But even in a healthy time, right, companies still can utilize the benefit of going to a loan broker. And this may answer some of your questions that you have down the line, but number one, right, a broker, in the time it takes one company to go to a bank, right? So they go to their bank that they're banking with, right? And it's like, okay, get me this, get us that, right? They move into underwriting a couple of weeks, right? And then it's like, okay, maybe they got approved, maybe they got denied. The point is that in that time frame, a broker could have gone to multiple different lenders, or he could have just gone to a single lender that he knows that would appreciate, this company's story and their financial condition. So even when a company is not in distress, there's just a tremendous amount of value that a broker can bring to the table.
That does answer some of my questions, and it actually brings up one of the ones we had for later, which is, what is the value of sticking with a bank and a banking relationship? Should people be shopping their loans around, or do they, I get that some banks like someone's better, so that you just said, but is there also value to staying with your bank, and how do you balance the two?
So relationships are definitely great, but it's also important to recognize what the nature of the relationship is, what the lender's capabilities are. I mean, take for example, I don't want to throw out names here, but there's a popular bank that everyone I know has their personal banking there, okay, and they have a very robust online bill pay kind of system. Pay your bills, send Zelle payments. Just a lot of very robust online system, and everyone loves banking there. So naturally, when they go and open a business on day one, it's like, hey, why don't I just go open a business account with the same bank that I've been banking with for the last 10 years? And again, the relationship sort of seems great, but all of a sudden it comes time to go knock on their door, on your banker's door, and say, hey, I need $1 million loan, or I need a $500,000 loan. And then all of a sudden they're not there for you. So, hey, you just had a banking relationship for the past 10 years or 5 years. In reality, they're just not that bank that's going to be with you. They're not going to be there for you as the business, as the enterprise grows. So yeah, relationships definitely help, but it's definitely very important to understand what their capabilities are. Just to give you another example, so some local community banks, right, they're great. You walk in there, they know your name, they know you on a first name basis, and maybe they'll give you $200,000-300,000. But then the question is, what about, hey, we went from being a small size business to a medium sized business, and all of a sudden we need a line of credit for $2.5 million. And hey, most community banks, they're not going to be there for you because they don't have the wherewithal to handle something like that. So even though you have that extensive relationship, it's only going to get you so far.
Okay, so it sounds to me like you're saying that, well, should people be thinking about this years in advance when they establish those banking relationships, or can you just solve it all by saying, okay, this bank won't do it, I'll go find another one when you need the money?
Well, look, it definitely should be, it should be something that should be planned in advance. Obviously, you can't plan in advance, 5 years in advance, or, if you'll need a $5 million line of credit. But you definitely should be looking for a bank or lender that, that does take relationships very seriously. You're not just another number. You want to make sure they're going to be there for you as you grow. So it is something you can try to plan for. It's not always something that may pan out per se, but it's definitely something that you can plan for. I mean, the other thing is that relationships may help you ultimately get approved for that line of credit or loan you're looking for. But then the question also is that, hey, is this the best possible structure for my business, right? So they'll say, yeah, we'll give you $1.5 million line of credit, but then they throw in all these covenants. They throw in all these ridiculous reporting requirements. So, some businesses may say, oh, great, I'm with this bank forever. They're willing to give me a substantial line of credit. But then if they came to a broker, that broker may be able to tell them, say, hey, what this bank is proposing to you, your relationship is not something your business could handle. And, we can probably do better by taking you to a larger or regional kind of lender. So It's a pretty loaded question. Really depends on a case-by-case basis, but obviously relationships do matter. It's just a question if that relationship's always going to be there for you, as the enterprise, scales.
All right. So I'm going a little off script here, but have you ever thought of setting up a business where banks pay you for sending them depositors, and you can send people to the type of bank which they need to be in so that when they need a loan, they can get
It's
it?
definitely a little out of the box kind of thinking. But that's what they're paying. That's what they're paying their business bankers for. That's what they're paying their loan officers for. A lot of them get paid for deposits and those kinds of things. I think of, I guess I'll have to think about it, but it would probably be a tough one if I had to guess. The thing with banks is that, like, right, everything is like, well, the bank's charter, bank policy, you're dealing with these corporate Elias, and you bring some novel idea to them, and it's like, okay, we'll run it up the chain, and then you start hitting red tape, or it's just like a flat out no. But I'm definitely going to take that under consideration.
All right. All right. So let's stop for a second, see if anyone has any questions, and then I'll go back to my list if we don't.
Okay, sure.
Anyone have any questions for Jerry? Or me, but mostly Jerry.
I have a question, Gershon and Jerry. I'm not sure if we have this for later in the program, but what's I want to talk a little bit about use of funds. So so you go to a bank, because what if you have a startup, they're buzzing along, they're starting to make some money, and the people that funded you to get there just want their money back. So you may be borrowing some money for growth, but in effect, you want to pay back sort of founder money. How is that? Does that make it particularly more challenging to switch to other people's money as you're growing?
Yeah, that's a great question, Bob. Really appreciate that. So you bring up a good point, use of funds, and maybe this is somewhere else on the list of questions too. But I think what people need to recognize, businesses need to recognize, no lender is just cutting blank checks for business loans. It generally doesn't work that way. There always has to be a need, and the need has to be justified, right? So where it's equipment or a piece of real estate, right, it's very easy to justify. But what about, like what you said, right, paying back founders, investors, and that kind of a thing? It's definitely way more challenging. I think that it would be very tough to get approved by coming to a lender and saying, hey, I need a loan to pay back my founders. It's very different if it's a note per se. If it's a formal note with a different corporate entity, then you're just talking about refinancing a note. But just to say, hey, I founded a company, I put in $500,000 in my own funds. I want a loan to pay myself back. It's not the kind of thing that most lenders would be interested in lending for.
But you just said something interesting. So if you're doing a startup, and let's say you get people to put up $500,000 to fund your business, it sounds like you're better off having them put it in as a note than just as money, right? Because then 2 years down the line, you're cash positive, you want to pay them back. Now an appropriate use of funds is to pay back a note as opposed to a dividend to investing shareholders, right? That smells a little better to the bank, is what you're saying.
Absolutely. Yeah. I mean, it just to bring up another point as well. So when we talk about startup funding, we touched on this earlier, pre-revenue startups or early stage startups. So there's two key products that most conventional lenders use when they're lending to small businesses. There's conventional loans, right? A line of credit, which is basically an interest-only loan. You draw down on principal, you pay that principal as you can. And then there's SBA lending. And SBA lending, there's a lot of misnomers, especially with the pandemic. There's a lot of SBA products out there for disaster relief. But regular SBA loans have been around for many, many years. And it's a basic program that lenders work with. Is called SBA 7A. Now, the loan is coming from the lender itself. However, it has a guarantee from the SBA, similar to what you see in the residential real estate market, Fannie, Freddie, those kind of programs. Now, with SBA lending, SBA 7A lending, they allow lenders to make these startup loans. But obviously, they're definitely more challenging, right? You have to come to a lender right? Because the lender still has exposure. Generally, the lender has a guarantee of 75% from the SBA. So there's still like 25% exposure. That changed a little with the pandemic. But the point is the lender still, has to take that risk. And right, startups are just a risky proposition. So it is possible to get startup funding. Obviously, it's more complex. The lender crosses their T's, dot their I's, both from the SBA's underwriting requirements, plus their own, right? They can apply their own underwriting requirements. So it is possible to get that startup funding. And I always tell people, like, try not to go to investors and give them a piece of the pie if you can get approved for that bank loan, right? Why give up equity in your own company if you can own your company outright 100% and get some sort of startup funding and pay that out over 10 years or something like that. So that's definitely a good point. But just to quickly reiterate, paying back founders, paying back investors is definitely super challenging. It's probably best that those things be structured as some formal note with a corporate entity.
Jerry, that's thanks for that answer. But you touched on something that's interesting in Gershon. I have seen this, where people are starting up a business. They're so hungry for money. They're willing to give away a chunk of the business, and they're not really thinking through what happens with the dilution somewhere down the line when they bring in another investor. They're not thinking about, and they're, I don't want to say desperate, but they're anxious to get that business going, and they're willing to give away equity. And it's tough to have that frank conversation with them of what that's going to do to them, when they're successful.
Yeah, absolutely. And I think we're going to touch on this a little later. We're going to talk about some other forms of financing, like what to stay away from. And really, like, what I find is that businesses that are like in a state of disarray, their financials are not organized, they sort of are not doing what they need to do to take things to the next level. And because of that, they basically end up giving a piece of the pie up, and they start looking for investors or these high interest loans. So it's just something to consider, regardless of what stage of your business is in. Hey, should I be going to investors, or should I actually be strategizing and get approved for some sort of conventional facility, as opposed to giving up a piece of the pie?
Now, Jerry, I have a quick question on what you're saying. If you've got a business which is losing money for the foreseeable future, and these are the types of things that we sometimes bump into, especially with startups, that they want to build out a whole technology stack. It's going to cost $2 million. Do they have any? And those are the people who often, not exclusively, but often those people are out there looking for investors. Do they have any chance of getting a loan, or is?
Yeah, a good question. So when you talk about losing money for the foreseeable future, I don't think a bank is going to want to lend money to a company that is going to be running at a loss for the next 2 years. They like lending to startups that, hey, okay, you have an idea, you have a concept. Once you execute it and you start ramping things up, it'll be a few months before things start taking off. They're not looking to lend money to businesses that are going to be losing money for the foreseeable future. Those are probably more investment banking kind of opportunities.
Got it. Okay, we've got a couple of questions. In one question in the chat, and then Brian told me he has a couple of questions. So Adina Frankel asks, is there a formula to determine how large a loan you need?
That's actually a great question. I mean, that's probably more for you guys, right? To determine your working capital needs, right? What are their true working capital needs? So it's not a simple, straightforward answer. I mean, if you're talking about a working capital kind of line of credits, or to fund inventory, it's probably best you have your cash flow projections, you have your forecasts in place, so you can anticipate the need. Otherwise, I wouldn't say there's any formal formula per se. Obviously, when you're talking about equipment financing, or you're buying a business, that's a different story. But to straight for working capital or inventory, It's really just about, getting your forecast and cash flow projections in order.
And I would also say that it depends on the type of revenue that the company has. If the company is a retail or a distribution business where you have to earn the customer every month, you don't get as much leverage on a company like that as you do when you have long-term contracts, recurring revenue, and predictable and stable cash flows. Those are more financeable with debt than the other types of companies, right? As you mentioned, I mean, equipment loans, things like that are a little bit different. But if you're financing an entire business, the nature of the cash flows also factors in.
Yep, absolutely.
Right. And
Awesome. I'll jump in. So I have two questions. The first question is, when you're preparing to go into the process of trying to obtain a line of credit or a loan, when you're speaking with the bank, those conversations that you're having with them and you're trying to sort of set the expectation of what the process is going to look like, how often does the process look like the way that you thought it was going to be? Like, how many times does it end up being a whole different process, and it requires so much more work and time in order to obtain it? Just because I want to know for myself, what's my expectation? Is it realistic when I have a conversation with a bank? Is it going to go the way that we expect, or is it going to go a totally different direction? That's the first question. And the second question is, you mentioned that specific banks are better for different types of lending. How do you identify which banks are the best exactly for your business? Thank
can
you.
I jump in for a second? That
Sure.
second question is why you call Jerry.
Exactly.
But I'll let Jerry answer the rest.
Yeah, absolutely. Yeah, that's what I was going to say. I was going to start with answering the second question. But yeah, absolutely. I mean, so really, to answer your first question, it's very important to have a candid, upfront conversation with your lender, with whoever you bank with. Say, hey, what does the process entail? And generally, it's I wouldn't say it's a uniform process per se, but most lenders ask for similar items with slight deviations from lender to lender. So I think it's very important, when you start exploring procuring a line of credit for your business, you talk to your lender and say, hey, what is needed for me? I want a complete list of items up front. Generally, there's not much more that's needed than there shouldn't be more that's needed more than that package. I mean, obviously, if they identify anomalies and questions and things like that, you may have to repair additional analyses, but it's usually not, that onerous that it's not something you can do in like a reasonable and timely fashion. Most lenders have that same basic foundational package that they look at. It's not really going to change much. We're talking about a P&L and balance sheet, historical tax returns, historical personal tax returns, personal financial statement for all the owners, year-to-date financials, maybe accounts receivable and accounts payable reports. It's a pretty uniform, not uniform per se, but it's pretty much identical from lender to lender. Sometimes as they dig into the meat of things, they have additional questions. You may have to provide additional information. But really, it's important you get a list of items that are needed up front, and make sure when you're submitting to the lender that you're submitting a complete package as well. I find a lot with a lot of scenarios where lenders are not necessarily so upfront and forthcoming about what's needed. It's like, okay, well, send me a P&L and a balance sheet. Okay, it takes them a week to review that. All of a sudden, they're coming back to you with additional requests. It takes more time to review that, and it starts getting a little bit out of control, a little bit out of whack. So it's just important to have that conversation with your lender up front. Nisa Isaacson asked an interesting. Brian, sorry, did that answer your question?
Yeah, thank you. I appreciate it.
Okay. So Nisa Isaacson asked an interesting question. Do you see any changes in bank lending policy since COVID-19? Sizes of loans, requirements, etc. So conventional, and that's really a great question. I think I sort of touched on this earlier. Conventional lending has really buttoned up. A lot of lenders have just completely gone haywire. They're starting to take risks, stock of some of their losses, and they're turning a lot of like loan covenants. They're actually they're actually taking advantage of those loan covenants. So it's very important, and I think I told all my clients, like, if you've had any issues from COVID or any issues for that matter, it's always important to be upfront with your lender. Talk to them about it ahead of time, so you can plan. Now, the worst possible thing, the worst case scenario, which is I wish on no one, is where a lender calls you up and says, "Hey, we reviewed your tax returns or your financial statements, and you're in breach of X and X covenant. You're in default on your loan," and that kind of a thing. In terms of the lending, actual new loans, I touched on this earlier, where they're looking at, well, what was the impact from COVID, right? So did you have a 2-3 month impact? Was it a more extensive impact? Let's see how you've done, right? So it's very understandable that a business has been impacted in March, April, May of 2020. So, well, let's see how you did the rest of the year. Let's see how you're doing in 2021. And as long as you're able to show that upward trajectory, and that you've either recovered or you're on that track to recovery, a lot of lenders are completely fine with that. I hope that answered your question, Nissan, but things have definitely changed. Conventional lending has tightened up. SBA 7A is a very, very hot spot now, because lenders have a guarantee from the federal government on a big portion of the loan. But conventional lending is definitely coming back to life. It's just about demonstrating that you've either recovered or you're well on the way to recovery.
Thank you, Jerry. That was very good. But I'm saying, as far as the banks themselves, have they actually changed policies? Let's say if a bank typically lent $2 to $5 million, are they walking away from those type of loans, or have you seen that at all?
Yeah, I've seen that. Yeah, absolutely. Yeah, case by case basis. Every lender is a different story. I've definitely seen that, where they change loan amounts, how they underwrite loans. It's definitely changing, but I see things picking back up already, meaning things have been changing already for the last 6 months to a year because of the pandemic. But I'm definitely seeing lending coming back to life. It's still not at pre-pandemic levels, but things have definitely changed to an extent.
What do you recommend to somebody that feels that their loan might be in jeopardy due to bank policies changing? Do you recommend looking at refinancing the loan, trying to negotiate with the bank, involving an attorney? What's the pathway?
Right. So the question is, if the loan is truly in jeopardy or not, or are you concerned it's in jeopardy? I would definitely seek to refinance a loan if it actually is in jeopardy. I mean, you can talk to an attorney. I mean, I'm not sure what you can do if you're if you're already in default. Some lenders do take some sort of offer and compromise. And some lenders do have some leverage for negotiations. But I just think today it's a tough time to negotiate. As lenders take stock of their losses, which they still haven't realized, many of them. I think it's a tougher time to negotiate, and probably the better option is to seek to refinance.
Thank you. Very good. Thank you.
All right. I'm gonna go back to our regularly scheduled program, and we'll see what we get through. Maybe we'll have you back for a follow-up.
Way to do it.
All right. So what do you do to get a company ready for a bank loan? What's your process?
Right. So for me, it's more about guiding the company more than what I do per se. But obviously, because I have the accounting and auditing background, I definitely have somewhat of a competitive edge. So I work in compiling the package with them. And it's not just about packaging it up and shipping it off to 50 lenders, hoping something sticks. I underwrite the deal myself, as if the lender itself was looking at it. And I have to make sure, together with the client, that things are actually presentable, and that it's actually a deal that we can present to a bank. I can't begin to tell you how many deals I look at where financial statement are just like in a complete state of disarray. And I have to recommend to them, say, hey, clearly your internal bookkeeping processes are not working for you. I think you may need to talk to an outside accountant. I'll give you another example. Right, so a typical report that most lenders will look at is say, hey, send me an AR aging report, right, an accounts receivable aging report. And when I see that the majority of the balances in the AR aging report are greater than 90 days, it sets off alarm bells. And that's something that's going to set off alarm bells in a lender's head. And that's going to throw off the balance sheet too. So that's the kind of thing where I add value and I come back to them and say, hey, we need to clean this up. We need to clean that up. So really it's about adding that initial value so that when we present to lenders, we're presenting them with a complete and accurate and clean package. And that's really where I add a lot of value. I also understand the operational side very well as CFO and as an auditor. So I always tell my clients, right, you can be a super profitable business. You can look great on paper. It doesn't mean a lender is going to want to lend to you. There's the qualitative aspects of the story as well. So I'm able to bring that out. I talk to my clients. I ask them very specific, detailed questions about their business, their processes, their growth, who the owners are, and I'm able to put together a very nice, detailed write-up and executive summary of the business, so that when lenders get the package, right, it's not just looking at a set of financial statements. I'm really able to help tell the story of the business and the owners along with the actual financials.
Got it. Good. I think that kind of covered some of our next few questions. So let's jump to personal guarantees. And once you're talking about that, please tell us about SBA as well. So do these loans require personal guarantees from the business owners? How about if there's multiple business owners? How does that work? And are there ways around it?
Right. So that's really a great question. And it's a very frequent question I get from clients and prospects. How can we avoid a personal guarantee? The short answer is that I have yet to see a business loan, both in my auditing days, both in what I do today, that did not have a personal guarantee. The way most lenders view it is that, hey, if you don't believe in your business, you're not willing to sign that guarantee, why should we lend you money? So that's really the answer in a nutshell. It's very tough to circumvent. Now the question is, hey, what if someone's a 5% owner in a business or a 10% owner? Are they still going to have to personally guarantee? So there's thresholds. I would say that the most common threshold is 20%. If someone's more than a 20% owner in the business, it's likely they're going to have to personally guarantee the loan, especially in the SBA space. In the SBA space, that is an absolute requirement. Anyone with more than 20% equity in the business is going to have to personally guarantee. Now, some people try to get a little smart and it's like, hey, so let's restructure the ownership. Now, with a conventional loan, that may work. But on the SBA side, the SBA requires that the lender do a look back. They say, oh, okay, there's some ownership changes here. They don't want that people are just trying to avoid the guarantee. So they're basically going to require the lender to look back. I think it's a 3-month look back period. So if there's any ownership changes and it happened less than 3 months ago, it doesn't even matter. So most of the time they're going to require a guarantee. In some instances where you have, a majority partner is a super strong guarantor, high net worth individual, you may be able to say, okay, let's just have this individual guarantee and let's do away with the guarantees of the other partners because they don't matter much either way. But for the most part, there's always going to be some sort of guarantee required one way or another.
And does that stop at a certain size loan? I mean, huge businesses, McDonald's borrows money and there's not a personal guarantee there.
Right. Yeah, with enterprise sized loans, McDonald's, Coca-Cola size loans and that kind of a thing, there likely won't be a personal guarantee. But you're talking about facilities in the billions of dollars. They're relying on the strength of the company. It's likely the company also has substantial amount of collateral to secure the loan with, not just general business assets. I'm talking about actual hard physical assets. But when you're talking about small, medium-sized business loans, there's always going to be a guarantee in one way or another. Even in a C corp, they're likely going to require the majority shareholder to guarantee.
Mm-hmm. Now, there are alternatives to bank loans, and we have at least one person here, Stacy, who works in the alternate loan space. Are there? Hey, Stacy. Thanks for coming. But
Stacey, that's Stacy. Okay, hey Stacy. Yeah.
So, is there do you ever come across a situation where someone says, "Oh, okay, it looks like we have two." Are there ever situations where someone says, "No, we absolutely don't want it," and you say, "You know what? Then the bank loan's not right for you," or do you tell them, "Get the bank loan and just take the personal guarantee and deal with it"?
I mean, look, really the next best product after conventional financing, which is where Stacy focuses, I believe, is really a accounts receivable factoring, which is where essentially the lender or the factor is basically lending against invoices, specific invoices from the company's customers. Past that, I would say stay far away from that stuff. You're going to be paying for it in some form or another. And I see, for example, Dina Frankel just asked, what would you consider to be bad debt? I guess this is where we're headed now with this conversation. I highly recommend that people stay away from most private lenders. Again, accounts receivable factoring is probably the safest form. It's very straightforward. There isn't much in the way of fine print. You know what you're paying, you know what it's costing you, you know what the process is. Anything beyond that, whether we're talking about cash advances or other onerous private kind of notes, I just recommend to stay away from. I know that in the private lending space, everyone likes to tout how they've saved companies and how they're saving America's businesses. I have yet to meet a company that has taken out private notes or cash advances and that said, hey, this was actually for thank you, Stacy. Yeah, cash advance loans equal bad. But I've yet to meet a private company that has said, yeah, we took a cash advance and it was super helpful. It saved our business, or was able to take our business to the next level. There's just too much deception in the private loan industry. And Gersh, I'm not sure if I told you this, and I highly recommend this to everybody. Google Dirty Money, episode 2 on Netflix. It's a worthwhile watch for anyone that ever considered a private note, a private loan for your business or for your client's business. It really more focuses on payday loans, which back in the day were really personal loans. Let's say someone couldn't help pay their mortgage, so they make this payday loan and they take the money straight out of their paycheck. It literally mimics how cash advances operate and how they're structured. I really highly recommend it. I recommend it to all my clients once they start talking about cash advances. But again, it's just super, super dangerous to get involved in. And I can almost guarantee you that outside of accounts receivable factoring, these private lenders, and they don't want to call themselves lenders. They take that as an offense because they're advancing cash. It's just something that people need to stay away from. It's not going to be beneficial for the business. I can promise you that.
What type of interest rates though isn't AR factoring pretty expensive debt?
So factoring, it's definitely more expensive than conventional lending, but again, it's the kind of thing where the structure is very straightforward and understandable, and you can build that into your margins. Compare that to cash advances where they tell you, oh yeah, we're paying, we're going to charge you 1%, but then all of a sudden it turns out you're making daily payments, maybe weekly payments. And then when you compare the 1% that they told you they're going to charge you, you're compare that to a bank loan, you know, and you factor in an APR, all of a sudden it turns out you're paying 100%, 200%. The reason why I just think that factoring is a safer bet is, again, just because the nature of the relationship, it's way more straightforward. The fine print, there's not much in the way of fine print. And for a company that's in high growth mode, they have a lot of receivables. They can't get approved for a substantially sized line of credits. It's definitely the next best option.
And to your point, if you can build that into your margins, you can decide if that rate, which is a rate that it's not, you don't look at it necessarily as a rate, it's an amount of money that you're going to lose 5% on every invoice. So if you can still make money and you'd rather grow quicker and get 5% less, which might cost you, 20 or 30% of your bottom line, but if it enables you to scale rapidly and you know the deal before you start, and it doesn't compound, doesn't change, it's just that could make sense.
Absolutely.
I want to respond to a question that Dina put in the chat about what you would consider bad debt. So I'm sure that a lot of what we just discussed would fall into that, but I want to talk about a different type of bad debt that I've come in contact with, which is debt. And I'll just start off by sharing the two categories. There's debt which you're using to help grow your business in the future, and there's debt which you're using to solve your problems from the past. And debt which you're using to solve your problems from the past means something didn't go right, now you're stuck with that and you got to pay for that going forward, and it's not creating any value for your company in the future. So say you lost $500,000 last year and you borrowed money to cover it, and now you got to pay off that $500,000. That ends up being a drag on your company. Whereas if you borrow $500,000 and that enables you to hire new people or do whatever it is that you need to do in the future, that's what I would call good debt.
Yeah, absolutely. Absolutely. And I think you touched on this earlier, right? Keep in mind, when a business is in distress, it's going to be much harder to get a proper form of financing. And, it's very easy to fall back on some of these other options like cash advances or other forms of private lending. And although that may be a tough time for you, don't make desperate moves. Don't make desperate moves. You have to make smart moves. You have to understand the long-term implications of what and the nature of the relationship. It's super, super important. If you're losing money, I think that you need to bring in Gershon or Bob and figure out why you're losing money, and see if you could plug the holes. But the key is not to make desperate moves. So what you're saying, Gershon, is you're ultimately going to be paying that for a long time, and it's going to be likely going to be a drag on the company.
All right, we got a couple more comments over here.
Okay, so Bob's he's deploying a common CFO, I would say CFO tip and trick, right? So Bob basically said, I suggest trying early payment discounts before going to factoring. It may not work, but I would try that first. Yeah, absolutely. Early payment discounts. I think this is another one. How about taking credit card? Taking credit card, so you get paid sooner. I think that's huge as well. I mean, obviously, whatever you can do, I would say that this is a good method in general to avoid having to obtain any form of financing. If you can increase your cash flow, get paid sooner, I think that would definitely be a good move all around.
Taking off on what Bob and Jerry are saying. So for those of you who don't know, I'm also a professor, besides for doing CFO stuff. And so one of the things I've discussed with my students, I don't know if we've actually implemented this at any clients, but the idea that by offering a discount, you are losing some percent. It's, let's say, taking a credit card costs you 3%, for example. And we actually implement this for ourselves, but taking credit card might cost you 3%. But if that means, and if you compound that, the rate is probably 40, 45%. But on an annualized basis. But the point is, if you're losing 3% and that enables you to not need an accounts receivable department because there's no one to chase because everyone pays you up front, that 3% shouldn't necessarily be benchmarked against an interest rate. you could benchmark that against the cost of your accounts receivable department. So if you can get rid of an employee and that costs you 3% of your revenue, 3% of your revenue, or 3% of your revenue on certain types of clients, and that means you don't have to chase people down, that you're saving money in other places.
I just want to throw in another, yeah, Gershon, that was great. Another area where a factor can add value, and you have to make sure your factor does this. There are different types of factoring. There's with recourse, without recourse, where, it's very possible that the factor is actually taking over the collection process for you. And I'll give you an example. One of my clients is an auditor. They dealt with big box stores throughout the country, from Target, Walmart's, and they're very difficult to deal with, right? You send them an invoice for $100,000. They send you back a payment for $75,000. It takes time to actually collect that. And you constantly have to be on top of it. And similar to what Gershon's saying, this company factored out all their accounts receivable because they saw value in, hey, we don't need to have an in-house accounts receivable department. We're going to have other people that are going to deal with this. We're going to pay them a fee. Might be a little bit more, but they just saw value in not having to deal with the accounts receivable factor. That's definitely something to take into account.
All right, I'm going to skim the questions and see if we have any other major.
Yeah, Stuart Stein says, do not use company funds for personal use. Absolutely, 100%. I think this is a very valid point when it comes to business acquisitions. You see all the time where companies want to sell, right? Buyers come to me, they're looking to get a loan, and they don't have a lot of consistency year over year, whether it's top line, bottom line, and you always get back responses, well, the owner is running their personal expenses through the business and this and that. And at that point, it's you got to start questioning the accuracy of the company's financial statements. Because, hey, if they're running personal things through the business, who knows what else they're running through the business? How do we know how much they're running through the business? It's always very important. Keep company funds separate. Personal use, absolutely not. Just stay away from that. I'm not even talking about legalities, right? Deducting things, personal things, taking them as business expenses when you shouldn't. I'm just talking about from purely understanding your company's operations, financials. And when pushing things to a bank, it has to look presentable. And if you're going to start telling them you're running personal expenses through the business, chances are they're going to tell you to have a great day.
I was more talking in terms of a bad debt. I've had experience with clients. They would go and take out lines of credits, whatnot, in their company, and then immediately draw those funds. Then personally, it's like what Gershon said, it's no value. It doesn't give the company any value. It's paying for past expense, mistakes, whatnot. They use it for their personal expenses, putting a down payment on a primary residence, something like that. And then it would be such a drag on the company paying all that interest and whatnot. And it didn't do anything for them for the business. They just, it was a growing business. They didn't wait till there was enough company in the business to increase their lifestyle. They said, well, I get all this financing, now let's increase my lifestyle. And the business wasn't there yet. And then it created a huge drag on the business because all those funds weren't used for the business. So I tell clients, if you need temporary financing for cash flow purposes and whatnot, timing issues, you got to pay payroll, but you're going to have the funds next month and you're going to pay it down and then back and forth. That's fine. But don't take the line of credit and then just pay your personal expense with it because you get no value and it doesn't help your situation.
To add another point, thank you, Stuart. It's likely that they're also in breach of their agreement with the lender. Right, the lender is not making a loan to the company so that to support the owner's personal lifestyle, and that's also that's another point as well. Companies that don't have a lot of equity are going to have a hard time getting a line of credit. Right, if owners are just consistently taking distributions from the bank's perspective, it's like, hey, you're taking out all your money out of the company. We're not interested in funding your lifestyle because that's in effect what they'd be doing if they'd extend a credit to this company. So for companies that have existing loans or lines of credit with lenders, they're likely in breach of their agreement with the lender if they're actually doing, as you say, Stuart. But on top of that, also for companies that are looking to get loans, it's very important that they build up equity in the business. Lenders like to see that owners are leaving money in the business. They believe in their company and they're not interested in supporting the owner's personal lifestyle.
Okay, I think we're pretty much out of time here. I have one more question about covenants. We have a question in the chat about from Robert Bishop about a specific situation, which I think we might need more details for.
I mean,
And-
20%, Robert, just to touch on, Robert's question is that he has a supplier is willing to finance his inventory to get, if he gives a 20% equity interest. I mean, yeah, I mean, look, I don't know, like Gershon said, I don't know the specific circumstances of the company or your financial situation, but 20% just sounds very onerous. And again, also, you're giving up a piece of the pie. I would also seek to, this is the perfect scenario where you have to figure out, hey, can I get approved for a line of credit or some other form of financing that's less onerous, instead of just jumping into this arrangement, just because someone's willing to throw money at you.
Right. Some of the questions I would have, it's not clear to me what it's 20% of.
Right. Well, maybe it's 20% of the deal, which I've seen quite commonly where, yeah, you want to buy $100,000 worth of goods. We'll take 20% of the profits from those goods. Regardless, it still seems like a lot. So
Depending on how low the profits are, if it's very tight margins, 20% could be pretty cheap.
Right.
So I think, Robert, you can reach out to Jerry or to us.
Yeah, sure. Feel free to send me an email.
All right. I think we're going to wind this down. We tell people it ends at 12. So thank you all for joining us. Thank you, Jerry, for putting on a wonderful presentation. I learned a lot, and I hope that you all did as well. Thank you again, Bob and Rebecca, and thank you to all of our guests today.
Yes,
if anyone
thank
wants
you for the opportunity. I really appreciate the opportunity.
And if anyone has any further questions, you can reach out to Rebecca. You should have her info, and she can put you in touch with us, with Imperial Advisory, or with Jerry, and look forward to being in touch.
Yeah, thanks so much, everyone. Thank you, Gershon, Rebecca, Bob. Really appreciate it. Have a good one.
Thank you. Good
Thank you.
Yeah, everyone.
Thank you.